listening right now to Bank of Canada Governor Stephen Poloz. He's speaking to media following his surprise move to cut interest rates. We'll listen in live.
Considerable uncertainty around the outlook for oil prices and the implications for the economy. My goodness. Having trouble get this piece of paper apart. Excuse me. There we go. However, every credible scenario for oil left us with a significant issue for monetary policy. We've based our analysis on an assumption for oil prices of about $60 per barrel for the next 2 years. Although this is above current levels, prices seem likely to move back above $60 in the medium term. The drop in oil prices is unambiguously negative for the Canadian economy. Canada's income from oil exports will be reduced, and investment and employment in the energy sector are already being cut. There will be some offsets, but they are both partial and of uncertain timing. First, Canadian consumers will spend less on energy, and they could save some of the windfall rather than spending it. And second, U.S. economic growth will be stronger, which, along with a lower Canadian dollar, should boost Canadian exports. But the speed of the export response is uncertain, given the export capacity losses of the last decade. The
bank has been projecting a natural sequence of higher non-energy exports, higher investment, and higher employment, which is needed to restore balance to the Canadian economy and to reduce financial stability risks. This sequence is gaining traction and will be strengthened by, first, the combination of lower oil prices, second, stronger U.S. growth, and third, a lower Canadian dollar.
However, these encouraging developments will be masked during the first half of 2015 by the impact of lower oil prices on the energy sector. Later this year, growth in Canada's non-energy economy should re-emerge as our dominant trend. But the first half slowdown represents a material setback in the bank's projected return to full employment and sustainable 2% inflation. So let me now give you some additional insight into our policy deliberations. Now, based on our assumption of oil prices at $60 a barrel, our first projection implied that it would take until late 2017 for the economy to use up its excess capacity. This would mean significant downside risk to our underlying inflation profile, which is already below target because of the expected dissipation of one-time inflation effects from meat, communications, and dollar depreciation. Now, obviously, these risks would be even more material if oil were to average $50 a barrel. Adding at least another year onto the period during which the economy would be operating below capacity and accepting more downside risk on inflation was considered unreasonable. Accordingly, we decided that it was appropriate to take out some insurance against that downside risk in the form of a lower interest rate profile.
Policy insurance is a logical part of our risk management framework. Today's action is intended to reduce the risk that our inflation path might move materially to the downside, as well as cushion the impact of lower oil prices and facilitate the economy's sectoral adjustment to its new circumstances. The bank has room to maneuver should its forecast prove to be either too pessimistic or too optimistic.
We also considered carefully the matter of financial stability risks. For the past couple of years, we've seen periods of downside risk to the inflation profile, but the horizon over which we believed inflation would return sustainably to target remained reasonable at around 2 years. Financial stability risks have been elevated throughout, sometimes evolving constructively, sometimes edging higher. but they did not pose sufficient concern to make it necessary to alter policy and delay further the economy's progress toward sustainable 2% inflation. La chute des prix du pétrole, toutefois,
The drop in oil prices, however, has two separate effects relevant to monetary policy. As already discussed, it materially increases the downside risk to underlying inflation, but it also increases the household debt-to-income ratio significantly.
While it is true that a lower profile for interest rates may exacerbate household imbalances at the margin by encouraging more borrowing, the far more important effect will be to mitigate those imbalances by cushioning the decline in income and employment caused by lower oil prices. Ultimately, we believe that the most reliable way to reduce financial stability risks is to do what we can to get the economy back to full capacity and sustainable inflation. Finally, we discussed the risk that by moving today, we would surprise financial markets. We generally prefer that markets not be surprised by what we do, and we believe that transparency around our analysis of the economy will minimize the scope for surprises. But in that respect, we took comfort from the observation that the consequences of the drop in oil prices appear to be well understood, and that the possibility of a rate cut had begun to enter markets in the last couple of weeks. Moreover, given the magnitude of the shock, we concluded that the benefits of acting now rather than waiting would outweigh the costs of any short-term market volatility that might arise. And with that, Carolyn and I would be happy to take your questions.
We begin with Nirmala Mano of the Wall Street Journal.
Governor, two things. One is, in your statement here, you said you have room to maneuver if your forecast is to pessimistic or optimistic. Your projections are predicated on oil at 60. Could you clearly say, does that mean if oil stays below 60, that you would be prepared to cut rates further?
Well, we can't be as precise as perhaps you would like at this stage. For us, this is not a business where we're being especially precise about how much we need to adjust in order to achieve what we're setting out to do. That's really why we're describing it as insurance, because we want to make sure that if there is more downside risk, that we have appropriately positioned for it. But we must remember that the world changes fast, and if it changes again, we have the ability to take out more insurance or, quite on the reverse, to reduce how much insurance we've taken out. But at this time, we simply don't have that kind of pinpoint accuracy that would allow a fulsome answer to that question.
The other question is, there are those who suggest that your move today, that surprise rate cut, is squarely aimed at targeting the Canadian dollar to boost non-energy exports. Could you respond to that?
Well, as we said in the press release and in our statement just now, this is aimed at protecting the downside on our inflation target. We've identified the risks, and those risks during 2015 are significant, that we would underperform our inflation profile that we've laid out before, and that along with that, it would take us quite a bit longer, perhaps, to close the output gap. So those things go together. So we are taking this action today in order to reduce that risk, and the market consequences will be what they are.
David Aiken, Sun News.
Governor, good morning. Last night in the State of the Union address, the President surveyed the American economy, saw growing employment, growing growth, and his quote was, in reference to that, "The shadow of a crisis has passed." I wonder if that, like a sundial, now we're in the shadow. Can you sort of maybe reflect on, are we in some sort of shadow for the next little while that America has somehow escaped from?
Well, I think it's true that most of the hard work of recovering from the financial crisis in the United States has been done, and the U.S. economy appears to be getting onto what I would call sustainable, self-sustaining growth track, or the term I've often used is natural. We must bear in mind that what we see in the U.S. economy is a good, solid picture now, but it's still happening at zero interest rates. So in any model of the economy, you would expect a lot of growth at zero interest rates. So what you need to bear in mind is that the headwinds that are primarily global at this stage, as opposed to U.S., those headwinds still exist. So they are holding everybody back to some degree. So the shadow probably will take longer than that to truly disappear, but I am very encouraged with what's happened with the U.S. And here in Canada, we are clearly benefiting from that, and we had far less of a shadow in the first place. So for us, it's more a matter of repositioning the economy in such a way that it fires on all cylinders. So we've had quite a period where the non-energy export sector has languished because of exactly what went on in the U.S. And so we're in that phase now where what we called in the last NPR the rebuilding phase. And we'll watch it with interest. It's not something we have precisely in our models. This is rather a new experience. So we are encouraged by that in the background, and all we're saying is we see all that. It's intact. This oil price shock, in fact, has some elements to it that would actually help it occur. And in the meantime, though, we have the overshadowing of this oil price adjustment, which will make our economy look less well off just for a period of time until those other effects come in more strongly.
And just to sort of just to focus on the consumer, on the household side of things, a lot of NPRs over the last 3 or 4 years, a common theme has been concern from the bank about rising household credit, that we're borrowing too much, be it mortgages or on our credit cards. I saw a little less concern in this NPR, and I wonder if you could put a little color on the phrase that was in there, household imbalances remain elevated. What are household imbalances, and can you give us a sense of where the bank's concern is as far as my bank balance at home?
So household imbalances remain elevated. Household imbalances, the quickest measure of that is how much debt compared to income do we have, and we're at a record high for the Canadian household sector. And the evolution of that is something which matters a lot to us because it makes the economy vulnerable to a shock. It's not something which normally changes by itself, but is affected by conditions in the economy. And so, for instance, we have one now. We have an oil price shock, which will reduce the income flowing into Canada and lead probably to some increase in unemployment overall. And that's exactly the kind of trigger that we imagine in the FSR, the Financial System Review, that could make these risks more real. Carolyn, would you like to talk a bit about the housing side and how the rest of that feeds in?
Sure. I think, as the governor said, the big point here is that this decline in oil prices has been a shock to Canadian incomes, which from a debt to disposable income point of view is not good news, and certainly the interest rate move that we made today is designed to offset part of that. And we have to remember that it's more than one economy that's going on here. We've got the effect of the oil price shock in energy-producing provinces, but we also have the non-exporting energy sector, and that sector, as the governor has said, has been doing pretty well. And what is really important for us to do is to facilitate that very needed adjustment. And by facilitating that adjustment, having more broadly based and firing on all cylinders, as you put it, will in fact be very supportive of financial stability and offset some of the negative effects of oil. I think the best thing that monetary policy can do in terms of financial stability at this point is to facilitate the return of output to full potential and to close the labor market gap.
Marc Godbout, Radio Canada.
Thank you. In annex to the report, you highlight that the effects on income will be particularly affected in oil-producing regions, but this can be dealt with through several mechanisms, and one of the mechanisms that you mention is federal budgetary policy. And so my question is the following: must the government use the next budget as a lever? And if so, what kind of intervention would you envision? You can answer in both languages if you prefer. Well, it's very simple. We do not comment on questions like that, except to say that in our forecasts, we use measures that have already been announced. We use, as input for our forecasts, announcements that have already been made. So for us, in our forecasts, the fiscal situation is constant. It doesn't change. I'll come back to the question that was asked by my colleague. You said earlier that the bank has room to maneuver in case projections are too pessimistic or optimistic. Does that mean that we could see a further decrease in the overnight rate if the price of oil is under $60 a barrel? Well, as I've said, this is not a question to which we can give a very specific answer. We need to wait, and we need to follow the effects. Right now, we're taking out an insurance policy against risks. But at the same time, there's a lot of uncertainty concerning the implications of this shock, the oil price shock on the Canadian economy. And for the moment, in our judgment, we need to take out this insurance, and we will evaluate the situation after several months. The size of the shock is at issue, and also we'll wait to see what the response of the economy is, and the response in the economy over time. There are offsets that we need to follow over the longer term. La Presse. Good morning. You said that if you hadn't taken the action that you took today, the production gap would only have been closed in 2017, and that you are worried that at that time inflation might drop so that there would be a disadvantage there. Does that mean that without a drop in the overnight rate today, Canada would be at risk of deflation like we've seen in Europe? No, I would say that that's not the case. In terms of deflation, then as economists, we talk about a deflation in all prices at the same time. That's not just a consumer price index that's negative for a couple of months. It goes beyond that. That's possible in our forecast, but that's not deflation in an overall economic sense. Certainly, if there are higher negative risks, we'll need to take that into account.
We are listening here to Bank of Canada Governor Stephen Poloz. He let out some jaw-dropping news today, talking about the overnight interest rate. It used to be 1%. Well, it has come down. It is now 0.75%, 0.75%. Our business host, Scott Peterson, has been listening to this news conference. He's been taking questions from reporters. Stephen Poloz has, Scott, and they've come up with this number of the new rate being 0.75%.
Right.
Using, what in their analysis?
Well, the downside risk of oil. I mean, basically they're trying to get a handle, and I think it's the first time that he's used the word oil price shock, which just means exactly that. What do we do with it? It's a sudden change. They were worried about inflation last month, but they're assessing everything on $60 a barrel, and they're below that. So he mentioned the word insurance, and that they were prepared to take out insurance as far as full-time employment, as far as sustainable inflation, because oil and gas has basically kicked the legs out from under them, and they're just revising everything. What's interesting, beyond beyond that is you could talk about, you know, speculation and all the rest of it, but if OPEC continues to pump out at full capacity, we're going to see oil at lower price, and it's just like trying to figure that out. If that's the new reality, he said we're going to take out some insurance and prevent that from happening and make money cheaper for everybody that needs it.
Because he did say this drop in oil is unambiguously negative for Canada's economy, but he did mention there are a couple of things that offset that.
Yeah, there's negatives. There's going to be a 30% drop in oil and gas investment. That's going to hurt jobs. That's going to hurt employment in Alberta. But the positives are exports. He mentioned that the U.S. economy is starting to flex its muscles because they got cheaper energy. So that means that we could have some manufacturing gains. But he did mention as well, there's a caveat that because we had so many manufacturing plants close in Ontario and Quebec that it would be tough for them to gear up. So he was concerned about how quickly those gears were going to switch from oil and gas over to manufacturing because the U.S. does look like it's picking up steam, and Canada bodes well for that.
It caught economists by surprise.
Sure
So
did.
many of them were expecting, the status quo. Let's have a look at markets and see where they're caught by surprise and off guard.
The canary in the coal mine for all of this is the Canadian dollar, because it was down substantially yesterday. And look at it now. It's like 80. It's about 80 cents, less than 81 cents. It has not been that low since 2009. So currency traders are pretty astute bunch. So this is a real shot to the system for that as well. And that's despite, look at oil. It's up over $1 a barrel. Usually the loonie follows that. So a big reversal for currency traders. Gold's down $3. The rest of the markets pretty much independent of this, and we're seeing other markets are pretty strong. Again, we're kind of following the lead of the U.S. a little bit. TSX is up 225, the Dow up 57, but certainly big news for currency traders and big news for mortgage holders and debt holders. This is good news for them. It keeps their mortgage costs low.
Thank you, Scott.
Thanks, Vanessa.